everyone, and welcome to the trading room for January 30th through February 3rd, 2023. This is Darren Fisher. I'm joined by Corey Halliday. Let's go ahead and get started. As always, trading contains risk. Make sure you're not getting over your skis. Well, let's talk about what happened last week here. So the markets finally broke out. They've been in this tenuous situation for a while, and there was a long-term trend line there that basically was in effect since January of 2022, all through 2022. We've been buttoned up against that long-term downtrend line, and we broke through it finally. And this coincided with just about the 200-day moving average as well. So the markets really kind of broke out of that, which you have to be more bullish at this point. One thing that we've been discussing here, and we're going to take a look at it, does this turn into a sideways market right now? There's no indications that it could, but we're at levels right now going back to December's resistance, that could be a period of resistance right there where we fall back over. There's nothing that says that. I just want to keep that in the back of everybody's mind, that one of the theses that we had for 2023 is that this could very well become a sideways, very choppy market. So this is going to be the first test of whether or not that we continue in the uptrend, or if we do break into that or transition into that choppy market. So just keep that in the back of your mind. So a lot of tech earnings hit this week. Microsoft and Intel did disappoint, but the whole tech sector surged. The economy is looking resilient for now. The GDP beat came in at 2.9 versus 2.6, and that was better than what the economists expected. I went over this on Thursday. The real outlier here was durable goods orders month over month. Economists expected 2.4% growth. We had 5.6. So the economy is still hot in some sectors right there. And that's really putting pressure on the Fed. They want to cool the economy down so that inflation does not eat away at everything. So that they're trying to thread this needle. Now, the number that they were looking at, and the number that got a lot of people excited today, was that core PCE price index. And the Fed has said in the past, we're looking at this index a lot more closely than we have in past years. And that's going to be one of the major inputs that we base our decisions on. Well, this came in line. So a lot of traders out there, a lot of portfolio managers said, well, look, this came in line with expectations. Does this allow the Fed some breathing room to not do as many rate hikes as what they had planned on doing? So that's why, that was probably, if you're looking for a reason why we did so well this week and, Friday especially, those were, probably, the big ones that went through: the quarter-over-quarter GDP, the durable goods orders, and that course PCE price index. So let's look at the markets right here. And you can see the Dow was up 1 3/4. S&P was up 2.5. The Nasdaq really outperformed there, up 4 3/4 for the week. Russell still did pretty good, up 2.5. Oil was down slightly, down 2.73%, and gold basically went nowhere. Gold was just sitting on the sidelines, letting everyone else go play, and just watching the game back and forth. Really did nothing. But we take a look at the S&P. And you can see we've still got that resistance up there at about 410. I mean, we've been talking about this for a while here, looking at some lines that you could draw. That just that area between 408 and 410 is going to be resistance. Then, if we break through it, great. If we don't, then I think if we roll over, then I think we are range bound between that 380 and that 410 area right there, at least for a little while, till we can decide what we want to do. Going over to the Nasdaq, you can see we're butting up against that resistance a little bit more. And if you draw it about that 297 area right there, up to about possibly 300, you can see that on Friday we tried to pierce above that, but then basically the sellers came in and said, no, this is a resistance area. This is a good place for me to get rid of my positions or institute new short positions. So you have that medium-sized upper shadow on Friday's action right there. But you can't, technically, we just have to say that we have to be a little bit more bullish until proven otherwise. If we do roll over right here, I mean, we've got major resistance down at the major support, down at the 260 level. So that if we do roll over, that could be the range for the NASDAQ. Corey, what's your take on the market?
Yeah, so I've had this outlook. Anyone that's tuned in to the market roundups on Tuesday certainly knows that I've had this outlook that's pretty darn bullish. I thought that max pain was basically a push up above the downtrend lines, up above the 200-day moving averages. We would see this flurry of buying above that, and the NASDAQ going up here is kind of the final domino to tip over, basically. Kind of think of it in reverse. If the market's going down and in a sharp downturn, you'll have the groups that are most under pressure. They're the leaders to the downside. And then you have some groups that are holding out and they're kind of relatively strong. But what will normally happen in a bear market is those will get pulled down in the last stages, right? They'll hold out for a while and then the pressure becomes too much. Well, we've basically had the opposite in markets where the breadth of the markets, like the number of stocks above their 50-day moving average, has been 75%. We've been moving higher, but the indexes haven't shown it as well as just the broader markets. If you were looking under the hood, you'd say, well, all of these stocks, most stocks are going up. Most stocks are healthy and strong for the last while, but large cap tech, which is such a big weighting in the S&P and in the Nasdaq, has kind of lagged behind. And so it's the opposite effect. Everything else was going up and they were the strong ones, and large cap tech, which is Tesla and Apple and Google and Amazon and Meta and Microsoft and so on, they were lagging and they were really holding the indexes down because they're such a big weighting. My expectation would be that they were kind of the final domino that would be the flurry finish, and that this probably what we're starting to see this week. We've broken out. We've cleared that resistance, and now the NASDAQ and specifically those large cap tech are really flourishing. We're not too far off of my thesis being done from the buy side. And so I don't mind the idea of kind of going into a consolidation or even a reversal after this plays out, because I think they're at the back. They were underperforming for so long and holding the indexes down. Now they're the last domino to fall on the upside. And we're getting later. And I've been expecting a good sized rally for quite a few weeks now if you've followed the market roundups. So we're getting late innings of that. If this was a 9 inning game, well, the game started late last year, and we're getting late in that cycle of kind of this big rally that I expected early this year. Good price action there in terms of the NASDAQ. And the VIX is really surprising. I'll let you opine on that. But the VIX, even though there's a lot of volatility, the VIX continues to decline to the downside. And sometimes when you see short covering rallies and big moves, because the VIX is just a measure of volatility, sometimes it will go up even when the market's going up just due to it measuring overall volatility. It continues to bleed lower. I'm not sure that there's a ton more downside in the VIX because I suspect we're going to have quite a bit of volatility there. Your thoughts on the VIX, Darren?
Yeah, I mean, anytime I find it best to think of the VIX as a measure of complacency. The lower the number, the more complacent people are, the more they're sitting on the hands, the more they're taking long lunches and just saying, bye, go ahead. They're not really watching the till as close as they are. When you get the VIX up at 32, everybody's glued to their screens. Everybody wants to see what's going on. Everybody's paying attention. You get down here, it's like you kind of have to ask yourself, who's minding the store? So part of it's probably my pessimistic nature, because if we look at a measure of the VIX in 2020 and 2021, it was predominantly pretty low, because when you're in a strong bull market, nobody wants to be hedged. And that's completely understandable. But we get down here, either we are entering a nice bull market, or at least the beginning stages of one, kind of hard to say at this point, or everybody's so complacent, we're going to get our legs chopped off. Either or scenario, but that's the way I see it right now.
You know what's really surprising? If you look at put to call ratios, And put to call ratios is basically just how many puts are being bought compared to how many calls are being bought. We hit a record high number in put to call ratio right here in December, which is pretty wild when you think about it. All the times that people could have been nervous and negative and bearish, the put to call ratio hit a new all time high in terms of its ratio. Well, I don't know if it was an all time high. I think it was. It was the highest point that you can see on a 20 plus year chart. And it hit its high here in December. So people, to your point of complacency versus nervousness, people got really, really super nervous about the markets and about positioning and so on in mid-December. And the amount of pessimism and bearishness reached a crazy high number. And it's a little counterintuitive, but there were so many puts being bought compared to calls, which tells you that, and this was part of my thesis for why I really got bullish. This is just one aspect of it, one pillar, so to speak. But this protective nature, if they've loaded up on puts and you're an institution that owns a bunch of stocks, you have your protection. So if the market goes down, you don't give in and sell because you're protected. Your puts go up in value while your portfolio goes down. You don't have to sell in a panic. You don't have to get nervous. And so the more puts were bought, the more it kind of protected the markets against a deep downturn. Well, the put to call ratio has obviously backed off significantly since that time as we've gone lower in the VIX and much, much higher in the markets. But I mean, essentially, those puts are going to be wiped out. They're going to expire worthless here in the February time frame, and January's already have expired worthless, and so on. And so those were the front 2 months when this was just getting loaded. And usually the front 2 months, remember, are very important in options because they always create the front 2 months of options. You're not guaranteed to have the third month in monthly expirations, but if they don't have it, as soon as the front month expires, they'll create it, right? You always have the first 2 months. So when you're looking at something like the put to call ratio and they were loading up on the puts, and that was happening in December, it was the Jan and it was the Feb that were most aggressively bought. We've already let those expire. These are about to on the 17th. And that means that a lot of the protection under the market goes away in mid February. But for now, again, those February options are set to expire worthless. It was definitely not a good time. It's counterintuitive, but when everyone is pessimistic like that and loaded up on puts, it creates much more of a bullish signal than anything else.
Great analysis there, Corey. Yeah.
Couple other things here. So this week's events, we've moved through those resistance zones, right? We've gone up through the 200-day, gone up above the trend line. Markets are going into some big events this week. The Fed meeting, non-farm payrolls. We get ADP employment on Wednesday as kind of a precursor to the jobs number on Friday, but markets always pay much more attention to non-farm on Friday than they do the ADP. So the FOMC meeting, the expectations are for a 25 basis point rate hike. Now, if you look at market pricing as far as interest rates, they're expecting a 25 basis point hike this meeting and a 25 to 50 basis point hike in the next meeting, and then a pause by the Fed. And then in late 2023, they're expecting the market's pricing in rate cuts. That's the way the Fed curve looks. So how do we get to that scenario? Why would the Fed, if the economy's strong and everything's good, why would the Fed start cutting rates in late 2023? Well, they probably wouldn't, right? And so what the markets are kind of telling you is that we're beating back inflation. Inflation has started to turn over, but by the end of this year, the Fed's already going to be cutting rates because there's a lag effect between when the Fed does things. It's not like they just snap their fingers and it impacts the economy. There's a lag effect. If somebody gets laid off from their job, they're not immediately in financial trouble. they've got some help for a period of time and so on and so forth. There's a lag effect to all these things. There's also kind of the effects of just psychology. If Uncle Bob got laid off and your neighbor got laid off, you as a family might sit down and say, okay, we need to hunker down a little bit and make sure we're okay for the next little while. There's a psychological aspect to this, and there's kind of a trending nature to economics as well. So late cuts in rates would basically suggest that economic data has rolled over ahead of that, right? That maybe towards the middle of this year is when we're really going to see the economy starting to get hit by all these things that the Fed is doing right now. So remember, the markets are always trying to price things in ahead of time, and the market has basically been pricing in lately, has been pricing in better economic conditions, probably pricing in that the Fed is pausing and not going to hike rates by as much as was previously expected. In fact, this came down from the expectations of a 50 basis point hike to now 25. So the market's already kind of caught wind of that, right? I think in the middle part of this year is where you're likely to start to see economic conditions weaken and soften. And so, if the market's right about its pricing, we probably would start to see recession type of numbers and those sorts of things later this year, maybe middle part of this year. That's when job losses and all those things can start to take effect. So, again, the economic data, as Darren talked about, was pretty good and beat expectations pretty much across the board this week. But we might be seeing a little bit of a peak in terms of economic conditions right now, and then it starts to get a little bit softer, a little bit weaker. Like I would expect the GDP to start to trend lower here over the next couple of quarters. It's almost like the first quarter is the best quarter, and then it gets a little worse as 2023 moves on. Now, as we look at expectations again from 4.5 to 4.75 is the expectation. Still pretty high in terms of rates compared to what we lived with for the past few years, where Fed funds was at 25 basis points. I mean, basically zero for multiple years. So this is a new normal. This is something that the economy is going to have to adjust to. And you're already starting to see employment and things get a little bit worse. Not terribly worse, but you can see last meeting to this meeting, a little bit of a slowdown. You're starting to see tech layoffs and some of these things where they're all the big companies. Apple hasn't yet, but all of the rest. Microsoft has announced them, Amazon has announced them, Google has announced them, and so forth. Again, there's some lag effect there. Weekly and monthly outlook, we've increased +1 on the weekly, +2 on the monthly. I wouldn't be surprised personally to kind of look at this in terms of the markets that maybe there's a little mini cup and handle type of thing. Maybe you get a little pullback and then one more surge. But if this runs sharply higher, what I've said I'm watching for at the tail end of this rally is a big blow off top. Look for a big, explosive, expanded range candle that kind of gives you a sense that it's the exclamation point at the end of this thing, that it's kind of the exhaustion point where the runner sprints for the finish line and then is just absolutely exhausted. It would also be the point of max pain for the short seller where they're forced to cover and so forth. That should be kind of at least temporarily the end of this move. So if you get a big blow off top, I'd look for that as kind of the exhaustion point.
All right, let's take a look at some of the sectors here. Kind of interesting to look at them. You look at the histogram right there. Everything was pretty positive. Okay, you had utilities and healthcare down just fractionally, all both under 100%. The three big movers were consumer, tech, and communication services. And we're going to take a look at all these, but it was a good week all the way around. Materials and energy really didn't participate much, but we've got 6 sectors that really have moved. So let's take a look at things individually here. All right, so utilities, I got it at -1. I mean, they're just hovering there. They're kind of range bound between that 68 and that 72 area right here. They look like they might want to want to go a little bit lower. They're one of the weakest sectors out there right now. So, I would say sideways to slightly down for utilities. Compare that to communication services. This is the first time in a long time that I've had a +3 on communication services. Above the 20, above the 50, the 20s above the 50-period moving average. We've had a nice march up. It really doesn't look like there's a whole lot in the way of resistance. I mean, this is the sector that's been beaten down so much last year that I think you're getting, we based from October really until, till just a couple of weeks ago. It finally broke out of that 52 area, and it looks like it just wants to keep going up. I mean, so you've got a 3-month base. We could very well get a 3-month, bull market communication services. I'm not going to make that call right now, but if you're looking for some longer term trades, I would say comm services is the place to look for your bulls. Real estate looking a little bit better than it did last week. Went from a +1 to a +2. It kind of it finally broke out on Friday of that 40 area. That had been resistance for a couple of months right there. So this is looking a little bit better. Not as much velocity as some of the other sectors. I mean, real estate usually moves fairly sedately, except when you're looking at from August to October, that went down pretty precipitously. But on the way up, it's pretty sedate. This is definitely looking better than utilities. I think they're wrapping their heads around the interest rate situation right now and finding ways to deal with it. So real estate's looking good in the short to medium term as far as I'm concerned. Looking at industrials, I'm at a nice 0. It was a -1 last week. I'm at a 0 this week. Industrials have been doing really, really well, but now it just looks like we're range bound. And we're not near the top of the range. We're not near the bottom of the range. We're just right in the middle of that aimless trend right now. So I've got, I'm neither bullish nor bearish on industrials. I would hope that a little bit later in the trading year we can break out of this range, because when industrials decided to start running, they started running really, really nicely. So we're just going to have to wait and see if that happens. Healthcare. This is the other weak sector along with the utilities. I'm just at a -1. I mean, you can see we're just at a small series of lower lows and lower highs, just slowly walking down, just like a deflating balloon from about mid-December currently. So again, this doesn't have the velocity of something that everybody's jumping ship on. This more looks like, hey, we've made a lot of money in healthcare over the past 2 years. It's time to start trimming some positions, and we just don't want to put any new money to work right here. Because you look at it a month ago, healthcare was looking really, really good. But now I think people are looking for other places to put their capital. So I'm in a -1 on healthcare. Financials are looking pretty good. Now, again, this is saying technically I got to give this thing a +2, but we're really near the top of November, December's resistance right there. I mean, it's so close. It's going to, you just expend a lot of energy bouncing off that 20-period moving average last week. You're coming up right to the top of the range. Do you have the gas in the tank to burst through that resistance and go on to make some newer highs in this trend? That's what we're going to talk about in about 4 of these sectors right here. Technically, I'm at a +2, but I've put a lot of things on triggers to make sure that I'm waiting until they break out of resistance before I go and make the trades. Looking at consumer, consumer had a really good kick. I mean, up 6% for the sector. I mean, last week I had consumer at 0. This week I've got it at a +2. It's just had a really good run, in the past week, and it even broke the resistance. You can see that 145 level had been resistance since really October, and we broke out of it decisively on Friday, and we approached it on Thursday, broke out decisively on Friday, and so let's see where it goes. This is another one where it just poked its head above what was resistance. Does it have the gas in the tank to keep going? I think next week with all the news going on next week, we might just get a choppy trading week. We might have to wait until the week after next in order to get confirmation on a lot of these things. It's just the type of market conditions we're in right now. Tech is another one that I took a look at. I'm at a +2. We broke through resistance at that 135 level that it had set from really November on, and now we're going to see. I mean, this is one of the sectors that really helped to drag the Nasdaq up, even though earnings didn't come in as good as a lot of people wanted. Is one of those periods where, hey, we think all the bad news is priced in. One more thing of bad news is actually good news. Okay, it's time to buy. I mean, if you're looking at a fundamental valuation standpoint, then you might want to dip your toe in the water and initiate some new positions. But again, that's the big question: how much money's behind these moves, and can they be sustained? Now, materials is looking really good. I mean, we've got a little bit of resistance that we established in December and a couple of weeks ago in January. Very nice orderly pullback to the 50-period moving average. And orderly moved up right to that resistance area again. Do we have the gas to break through it? Of all the sectors that you're going to see a rated +2, I think materials has the best chance of breaking through and going on to new highs. There's just a lot of demand out there that I think the materials sector is really poised to be able to take advantage of right now. So this is the one that I think is one of the better looking sectors for something a little longer term. Now looking at energy, still at a +1 on energy. Had a +1 the past few weeks. We look at it. One of the reasons you got to look at Friday's candle. We had a really nice candle on Thursday. We approached that 94 area, that 92 to 94 band that has kind of been resistance established in November, and then we kind of had a little bit of a reversal on Friday when the rest of the market was up. So there's definitely, I mean, we're still in an uptrend, but I just think this one's going to be a little more sedate, and people are going to have to look for reasons to get into energy again, rather than it just be a go-to sector for people to place capital in. There's just other places out there that people think they can get a much better return. So looking at everything side by side, healthcare and utilities are the weakest at -1. Industrials is neither bullish nor bearish at a 0. Energy's at a slightly bullish at a +1. But look at that. We've got 5 sectors at +2. Tech, consumer, financials, materials, and real estate. And then finally, communication services at a +3. So we've got 6 of 10 sectors that we can be really bullish on. And this goes back to your point, Corey. It's sometimes you have to look under the hood and see what's driving the broad market. You see the broad market is just kind of lagging, but then you've got 6 sectors that look really positively bullish. Maybe the underlying scenario is more bullish than what you think it is. So I think time's going to tell on that one. So let's look at some possible trades. Okay, so last week, we're going to hit utilities here, but last week we had a trade in real estate, and that was Weyerhaeuser. And we were sideways to long in Weyerhaeuser, and this is looking pretty good. There was a couple other trades you could have put on, but this one was up 7.15% a week. So this looks about the same that we were talking about real estate. Real estate's at a +2. They're getting a lot of stuff worked through the system. I mean, Weyerhaeuser owns vast tracts of forest land in the Northwest. So, I mean, they're primarily a logging company, but you want to call them real estate, call them real estate. But that trade's looking pretty good. This week, we're looking at energy. This is going to be DTE Energy. We're going to play this sideways to slightly bearish. You can see we're looking at the 105, 110, 115 put. We're basically saying this thing is at some point in time before February expiration probably going to drift lower to that 110 area. And once it does, I take half the position off and let the other half run till expiration. But this is looking pretty weak. You can see in a really good up week that we had, there was really no participation. It just kind of hung out there. That's in a really nice up week. The only thing this could do is, hey, we didn't go down, guys. Well, good job, DTE, but it looks like you might be going lower. And communication services, let's see, we were long Comcast, and that was up about 0.5%. Really, can't complain much. I mean, we still got another week or two on this trade. So it's still looking pretty good, in a nice, high base right there. It just didn't move for us very much. That's fine. We can't have winners all the time. So this week we're looking at Zillow. And this is another one in a nice high base. And when they're like this, I want to play this one with a call. Go out to the February 42s, go along those, and then just short this next Friday's 45s. You're only asking it to go up, about 50 cents in the next 5 days. If it goes up a little more, that's fine. You can keep those 42 calls and see what you want to do with them. But just for a 1 week trade, I think if this just hangs out here in this nice high base, then it's going to be a nice little money maker. Reevaluate what you want to do with it on Friday. And in healthcare, last week we were short United Health, and this one it was just got a lot of volatility on it, and you can see it went up there. Now we said wait for the trade to trigger. So if you waited until say Tuesday when it gapped up to 500 and then worked its way down all the way to 480. I mean, that's a 20-point move in a day for a stock right there. If you waited until then for it to trigger, you're probably looking on a little bit better. If you waited for it, I mean, you could even have gotten in say Friday. The trade's probably looking a little bit better. This is on a weekly basis. This is only down about 0.14%, but the trade still looks viable. So if you got some more time left in it, I would just hold tight. This week, we're looking at CNC, that's Centene Corp. It's a nice low base. A couple of different things you can do. I mean, you've got a little bit of support at 74 area, but it's not a whole lot. A couple of different things you do. You just do a 70-75 bear call spread, or if you want to go out, if you want to go out and play it with a little more flexibility, just go long those February 80 puts and then short this next Friday 75 against it and see what it does from there. I mean, this is good. I love being able to do diagonals like this, depending on which way you want to go. If you want to set it and forget it, or if you want to see which way it drifts lower, a couple different ways you can play it. And industrials. Last week, we were sideways to short on Love. It's Southwest Airlines right here. And this did exactly what we wanted it to do. It was down 2.2%. So this trade's looking pretty good. I think the midpoint on this was 35, so we're sitting at 36 right now. Give this thing another week, and let's see where it goes. One of the things you can do position management with targeted butterflies like that is as soon as the stock price hits your midpoint, get rid of half your position and just take the profit on it and let the other half run until expiration. And you can see what gives you the time to take a profit and just let the normal movement of the stock occur. Right now, we're looking at Raytheon. We're going to play this one sideways as well. You can see since December, we've just been vacillating back and forth on that 100 area. Now, on Tuesday's candle, I'm not sure if they had news. I'm not sure if that's a bad print on Tuesday's candle, but you can see it didn't get up above 105. So we've still got a really good, it did get a little bit above 105. But we've still got a really nice range here to play. So let's go out to February and play at 9,500, 105 call butterfly and just let this thing hang out there. It's completely fine to do that. If it wants to establish a base, then let it establish a base and let's make money on it. I mean, for anyone else, this is dead money. For us as options traders, this is a perfect time to make some money right there. And financials. Last week we were sideways to long on KKR, and this is another one that did pretty good. This is up 4.36%. So really looking good. I think 55 was the midpoint on what we had. And it's sitting there at 50, 55, 50. So this is looking pretty good right here. This week we're looking at Allied Financial. This is a nice high base. Had some news last Thursday, Friday, and now it's just up at a nice high base. I would play this, go out to February, go long those 30 calls, and then short this next Friday's 32.50s against it. You're just saying, hey, hang out here, give me 15 cents, then I'll reevaluate. If it breaks above that 32.50 area, you can decide to buy those short calls back and reset it to something else, or you can just get rid of the whole position. This is looking pretty good as well. All right, Corey, you want to take us through the rest?
Yeah, so let's take a look at the consumer area of the market. So consumer stocks jumped up quite a bit, but this one really lags. So this is ADM, Archer Daniels Midland. We had a short on this, it was down 1.32%. So pretty good, actually, in a strong bullish market environment where the majority of stocks were going up. Pretty good that we were able to pick a short there that went down during that period of time. New trade idea, here's Canada Goose. High base breakout idea. You could do the diagonal call spread or just a bull call spread. The bull call spread is certainly a little bit more bullish, would give you more upside, so it depends on your outlook. The diagonal would be a little bit more neutral, so kind of pick and choose depending on how much more upside you think it's going to have here between February expiration, but should be neutral to bullish is kind of our outlook on that particular stock. Next, we have technology. Now, in the technology sector, we had Taiwan Semi, and there's quite a few charts like this that have this weird candle. They did have an issue on the New York Stock Exchange with the opening, and they had some bad prints. They broke the trades and so on and so forth, but it still messed up the charts. I was hoping that they would clean up the charts and fix them, but anyway, that these aren't reality. It didn't really trade there. It kind of flashed for a second and then went back, and so it kind of looks weird on the chart. But anyway, the stock was up about 2.5%. We had a bullish outlook, so certainly the right direction for this past week. Square is the next idea, and this stock has broken out above this 75 level that you can see there, still working its way higher. I kind of put Square and PayPal and some of those in that same group, payment processors and so forth. Square has a little bit more risk and reward when it comes to the blockchain and Bitcoin and those sorts of things. So this one bullish, but kind of targeting a move right here around 85. Again, the diagonal is a little more neutral. The bull call would be more bullish. And this one, I would prefer the more neutral personally and kind of expect it to stay in this range. Again, neutral to bullish type of outlook on Square as far as the positioning. Materials sector. So we had a trade outlook bullish long on AVTR. That one was up 4.5%. So certainly working its way higher, as you can see. Pretty good price action out of this week. And not all of the material sector did super well. Gold and silver kind of stalled out a little bit, but this thing kept working its way higher. Next, we got Freeport, and this one as a neutral. So notice in a call butterfly, the 40, 45, 50, and the stock's right around 45. Just anticipating that while the stock may trade up or down a little bit, that it will find its way back towards 45. Pretty good risk to reward for a neutral butterfly. You do obviously have some catalysts, but sometimes when you have multiple catalysts like that, they can kind of offset each other. So if we rally on the Fed news, we might drop on the non-farm payrolls and so on. Sometimes it's just choppiness by the time it's all said and done. So Freeport is a sideways outlook and a possible butterfly candidate. And then last but not least, the energy sector. Here you've got LNG, which we had a sideways to short outlook on. It was down 1%. So that's pretty good. That was sideways to bearish, certainly, in LNG. If we look at FANG, which is Diamondback Energy, this one, we again have a sideways outlook. So 145, 150, 155 call butterfly. Very similar to Freeport, really, in terms of course, the stock's going to wiggle, but we anticipate that that wiggle will bring it back towards essentially not going anywhere. So you might get a little bit of a burst. Again, this is next week's expiration, Feb 3rd. So you've got some catalysts, but if it bursts to the upside or bursts to the downside, they may offset. That's kind of the thesis here in terms of the Wednesday FOMC, the Friday non-farm kind of sets up to be maybe the bark is louder than the bite. And so FANG, a possible neutral candidate.
So markets are breaking through long-term resistance. It doesn't matter what you feel. We have to recognize they've broken through long-term resistance. We have to get more bearish. The caveat to that is that December resistance may be in play. It may just be totally blown through. But looking at that, I think we're going to see a little bit of choppiness around those resistance areas. But in the end, you have to be short-term bullish in the short term. There's no case here to be bearish in the short term at all. You don't have to be super bullish. I wouldn't recommend it, but I definitely would want my portfolio to the positive delta side. So next week we've got the market roundups. We're doing candlesticks, bearish Marubozu. That's going to be recording right there as well. So we're looking forward to that. As you know, we record everything so you can view it at your leisure. So we'd encourage you to log into Maverick Trading, get onto the forum, post some of your trade ideas as well, share what you're looking at with the rest of the firm, the rest of the traders, and looking forward to it. So thanks for everybody for coming, and good trading, everyone.